Man, what I'll say, okay, don't overload yourself with debts that are non-tax deductible. Look, yes, you need a car, right? If you need a car loan, you get a car loan because you have no car. But doesn't mean you go out there and get a Porsche, a Lexus, whatever. To answer your question, whatever advice I can give them is live within your means.
Hi guys, thanks for tuning in, and today we have an awesome guest that spearheads the mortgage agency, Tony Xia. He's got some great insights as a mortgage broker. We've been engaging and working with him for many years, and he's had some really good experiences with investors out there, and I hope in this episode that you're going to get the most value out of him and some of the stories he's had to share in terms of scenarios and also some of the things that are recently going on, especially in the mortgage space. And now that the lending landscape has changed dramatically over the past 12, 24 months, I think no better person to talk to us today than Tony Xia.
So you say you're from out west too, Tony?
Sorry?
Out west?
Yeah, Stanhope Gardens.
Oh, yeah.
When we moved to Australia, I grew up in Campbelltown.
Nice.
Then
I live out that way now.
Right, then we moved to Rockdale.
Yep.
Then we moved to Punchbowl. Lived at Homebush for a little bit when my brother bought his. So next we moved to Londonderry, which is near Richmond. Flemington for a couple of years back and forth. For about 2-3 years, I moved around places because my mum lived in Londonderry, my brother lived in Homebush, and my missus lived in Menai. Wow. So it's like three different. Yeah, man, big triangle, right?
Something called Londonderry.
Yeah. Right. Yeah. The next, I moved out. I moved out to out here.
You've been there ever since?
Yeah, since 2015. That's when I first bought the place.
And did you get into, mortgage broking early on, or was that something you transitioned to later on?
It was always in banking.
Yeah,
I was in banking. I always looked after brokers on my last 2.5-3 years off my banking life. Then it was just a slow transition out to broking.
Yeah.
It just fell to face.
Yeah. Real estate, not your thing?
I still want to buy into it, man.
Yeah?
I still want to buy into it.
Like
I still want to buy
what, the property management side or the residential
the PM
sales?
side. The
PM side. Yeah,
I still want to buy it. Yeah. I still want to buy it.
Okay.
So back to so I was explaining about the banking side first, right? So look, I started CBA back in 2011, 10-ish when I finished uni. Yeah, so that's the first job. And progressively, I just moved.
Retail.
Yeah, in retail business banking.
Yeah.
Right, and progressively, I just moved my way up. And I had my big break in the business development side, working with brokers around Australia, etc. Right, so it's very interesting, right?
So you're doing BD work in the bank. And you're networking with
mortgage brokers. Not mortgage brokers, but more asset finance, commercial brokers.
Okay.
Right, so it's a different space, right? So it was always that's where I learned the development side of things, lending side of things, relationship management side of things, and all that stuff, right? So it was always interesting. But what really got me interested in residential lending is I had two mates, very close mates, right? Both in the home lending, in the banks. And we always talk. They always talked about lending. They always talked about scenarios. Always talked about problems, right? So naturally,
you were just surrounded by it.
The interest was just came up, and man, I just got over it one day at the bank, as you would, right in corporate, as you would. And I said, man, you know what? I got to get out of here. And the boys one day goes, you know what, man, we're leaving to start our own thing, right? Okay,
so they worked with you.
Wow.
Yeah. So you know what? I'm going.
They were two good mates.
Yeah, very good mates. So I'm like, I'm going, man. I'm going with you. I took the punt. I'm going, right?
What year was this?
2015. So I left the bank after the 2015 financial year.
Okay.
So I started running my own show, 1st of July, 2015. That's when I started.
Same as me.
Yeah, I know. That's when we met. When I saw you at North Parramatta,
100%.
talking to those two guys, right, talking to those referral partners.
Yes.
That's when we started catching up,
100%.
And that's when I found out you were leaving.
Yeah, 100%.
Right?
Yeah, North Parramatta.
Yes, North
Parramatta.
Parramatta.
That's where I worked.
And that's where my first office was.
Yeah.
Right. So since then, man, the business has grown. So it's been it's now my 8th year now. It's now my 8th year in mortgage broking. Right. I took about 12 months off, 14 months, because I really wanted to buy into a real estate business. I really want to buy into the real estate business because I was always interested in the property management side of the business, having it as an asset. Right. Because me personally, I found that to be my retirement fund, in a way, right?
It's a very good investment, isn't it? Property management.
Look, expensive to buy, right? But I think the long term is going to be there, right? But obviously, how much you want per dollar, that's another question, right? I did get offered to buy into the business, right? But man, I think they wanted close to about 600 grand for 25% share, and they wanted the money in 4 months. I'm like, wow. Man, where am I going to get
$600,000?
I mean, I could have done it, but not in 4 months.
Yeah.
Right.
Yeah.
But because
and that's for a quarter of a share of the business.
That was a quarter of a share of business as well.
Okay.
Yeah.
Right. So I could have done it, but no way I could have done it in 4 months.
Well, that just shows you how safe an investment it must be.
Correct.
For people to ask that type of money.
Yeah.
And I've heard, I know real estate agents as well, and I've heard that, when it comes to investing or buying businesses, property management has to be one of the highest, highly sought after type investments out there.
Yeah, that's right, right?
Yeah.
Because it's look, you have to think of it, it's like it covers the majority of your overheads. Essentially, like, as a business operation, it covers majority of your overheads.
Yep.
Right. So the way I see it, even with a broking business, yes, we get paid a monthly trail. That's how we get remunerated, because that pays my associates and my employees to service my customers.
100%.
Right.
Because it takes time and energy to look after people even after the transaction.
Correct, right? Like for example, I had a client that wanted to do calculations in planning, right? For next few purchases. Those calculations took my credit associate 2 hours.
Yeah.
We're not getting paid for those 2 hours.
No one's paying for that.
100%. And I think it's so often people don't understand that they think once their mortgage is done, their loan's done, the job of the mortgage broker is sort of done and dusted, but it's quite clearly that it's not.
It's not. No, it's not.
It's planning for the next one. And there's more things that you do in the back end.
That's right. And just a quick phone call from the client. Well, that's time. That's our time, right? Yes, we love to talk to our customers, right? But that's still time with our day that we have to spend time with our customers, and we don't get paid for doing things for free.
Yes.
Right. Like so essentially we're doing things for free, right? So we can't afford that. It's not sustainable, right? Do you know what I mean?
I'm not going to keep it a secret, but I don't want to tell you how many times I've called,
Yeah.
Mr. Mortgage Broker, and asked him, hey, I've got this purchase I'm looking at executing. Can you see if it can be done for me? And in this time frame, he says, so you want it tomorrow?
Yeah.
You want me to find 3 lenders?
Right.
And I don't go ahead with it.
Yeah.
Who's paying for that?
Yeah.
So I completely understand the troubles and that they go to make deals work, even when the deals don't come together.
100%, right? Look, like let's say for example on Monday I had 5 hours worth of appointments. 5 hours. I had 4 appointments, right? And I can guarantee you, only one of them we will be pushing through, because the other 4, was just planning, right? So
Plan to the seed.
Yeah. So look. So I have to make money from somewhere else. It's not costing you guys. It's costing the bank.
So as you touch on that sort of planning there, I know we're going to have a lot of, first time people who are wanting to take out their first loan or buy their first house or going to go for their first application. And, I feel there's a lot of fear from these guys because they hear a lot about the interest rates and things like that. What could be some tips or something that you could, speak to those guys who are going for their first loan or first application? What are some things that they could do to help better their case when they come to see you and they go to fill out that loan? What's some tips they could do or something they could focus on to help better their case for an application?
You always have to plan, man. Always have to plan, right? There's no point coming to me, hey, Tony, I want $1 million loan when you don't know the logistics on the back end, right? So I had this little young lady call me up the other day, right? Look, she's on decent money on as a first job, right? Straight out of uni, she was on about 80 grand, right? And she goes, hey, Tony, I want 80 grand, but I want to buy something for about $1 million. I'm like, well, all right, fair enough. That's ambitious, right? But man, have you worked out what the repayment is on $1 million loan, on $1 million purchase?
Is it sustainable?
Right, it's sustainable. That's the thing, right? It's sustainable. Yes, you can claim back negative gearing, you can claim back interest expense, you can claim back your depreciation from the property, right? But still, there's going to be outlay on.
Can you live on soy sauce and rice?
Exactly, man. Exactly. And that's
my
what
son can. I'll tell you that right now. Right? That's all he eats is soy sauce and rice.
He loves
it.
A good property investor.
Right, but that's what I'm saying, right? You have to plan. You have to plan. You have to work out a budget. You have to work out the repayment with a buffer on top. Yeah. Right. So I say to a man, look, the best thing to do is go on a calculator. You can find these online borrowing calculators online, anywhere. Right? Go and search online. You punch in the loan amount, you punch in the rate, you punch in principal and interest repayments, right, etc.
Do the quick math.
Do the quick math yourself. Work out your budget. Work out your cash flow.
What's left in my pocket?
Exactly.
And can I live on with that? Yeah?
Exactly.
That's
right.
So
yes, there's rental income, etc., right? But the rental income these days will not cover the interest repayment on a loan because the rates are so high, right? So yes, answer your question. You just have to plan. Work out your monthly repayment, which is very easy online. You can do it, right? Work out repayments. Work out what your net income is, right, per month after tax and all. Then take away your living expense. Right, look, you don't want to live off soy sauce, right? Because you're a kid, right? You want to live the dream, right? But work out a budget.
You want some prawns on the side.
Yeah, you may have some prawns on the side, right?
Well, she's a young lady. You never know.
I know. True.
Fine, Mr.
Fine, Mr. How you going, right?
Mr. How you going? Right. That'll change the dynamics of your career.
But you know what I mean? Yeah, to answer your question, you have to plan. You have to plan. You have to work out a budget, right? What's sustainable? That's what I say to a lot of people these days, especially with high interest rates. What is sustainable for you?
Yes.
Right, because if it's not sustainable, having $1 million loan is irrelevant, and we shouldn't be even having that conversation.
Yeah, fair enough. And that's one side of the thing. So what are some things that banks or lenders actually look for when they're assessing applications and they're doing things like that? Because I feel that people, don't realize that some of the things they're doing right now could affect their loan, could affect the application. So what are some things that they could potentially avoid or look to start doing when they're on that lead up to potentially going for their first loan?
Yeah. So look, if we are getting the loan with the bank you bank at, and you have all your transactions in there, you better watch out for your spending, because they can see everything.
And they're going to see it, right?
And they're going to see it. They're going to break it out. They're going to see it, right?
Yeah.
They say, hey, man, you're going to the bar every Friday. You're going to you're gambling every Friday or every week, whatever, blah, blah. And they're going to question that. Some of the banks that, look, if you're banking with Bank A, but we're taking to Bank B, they probably won't see that, right? Because most of the time they don't ask for those statements to see those whatever transactions you have. But it's our job to look at it and to question it. But the thing is, irrespectively, you should always watch out what you're using, what you're spending on. Maybe let's call it 3 months prior to getting a loan. Right? Because
so you want a clean book, right?
Yeah, essentially, right? And to be honest with you, you should get used to that habit anyway. Because once you get that home loan, you can't start going out every Friday. You can't eat out every Friday.
And that's why you go back to that sustainability. Like, it's great to, let's cut out these things.
Yeah.
But can I live long term without it? And
Exactly.
if I can't, then the question is, maybe I shouldn't be borrowing that money.
Exactly.
But if we're gonna, accept some of those challenges of having a mortgage, and we're willing to cop it, and we want to grow, then yes, let's look at cutting down some of those expenses, right? Long term.
100%, mate. 100%, right?
Change of lifestyle.
Mate, I've cut down my expenses like no tomorrow because of these interest rate rises, right? I've cut down my expenses like no tomorrow. I'm probably one of the person that caused a bit of the inflation, right? when
Just
the rates were
class instead of
yeah, business class, right? Just business class these days, right? Yeah, I wish, right? Stuff like that.
Yep.
Stuff like that, right? But yeah, look, like I said to you, you just have to live within your means. I've said it 100 times, live within your means.
And so what are some of the things that, if I was a first-time investor or a home buyer, what are some of the things that I should be managing my expenses on? Like, as an advice from you as a professional, if we're going out there, maybe when it comes to buying a car, is there a strategy around that? If we're buying our first car, if we're looking to go down the road of investing, where can we find things that we can save on? Like buying a car, reliable yet not overly spend on a car. Finance, because finance on a car would of course hit our credit and essentially affect our credit scoring. Correct?
Yeah,
things
correct.
like this would impact. What's some advice you could give for a first time investor going down that road? What would you give in terms of advice for them?
Man, what I'll say, okay, don't overload yourself with debts that are non-tax deductible. Right? Look, yes, you need a car, right? If you need a car loan, you get a car loan, right? Because you have no car. So be it, right? But doesn't mean you go out there and get a Porsche, right? Or whatever, a Lexus, whatever you want to call it.
Yep.
Okay? Because that would kill your borrowing capacity a fair bit. To answer your question, look, whatever advice I can give them, right, is same thing what I said before, is live within your means, right? Don't buy something that's...
Living at home with your parents.
Yeah, living at home.
That's a win,
Right.
isn't it? That's a
Eating
big
rice
one.
and soy sauce.
Well, living at home with your parents, yeah, right. But how long can you sustain that for?
Yeah.
Right? Because
If you're Asian, you could sustain it for a while.
right? Yeah, I know, right? But,
yourself?
Yeah.
Yeah.
I stayed home all the way till I got married.
There you
Right.
go.
Yeah.
right.
Same.
But how long can you sustain for?
Yeah.
Right? How long can you sustain for? Do you know what I mean? That's the most important question. I want to get back to your question.
Yeah.
What was it again?
What are some of the tips you can give someone that's going to property, their first property, and you as a first-time property investor, what would you do?
So look, obviously, your initial journey of investing, man, look, you sort of have to, exactly, watch out for your expenses. That's the most important thing, especially right now with the high interest rates. You're guaranteed there's going to be money out of your own pocket, right? You're guaranteed. So mate, it could be
because those yields of 5-6% now are pretty much swallowed up all in interest rates, right?
Exactly, right?
Not to mention the principal you have to pay back
Yeah.
on top of the interest repayments that you have to
Yeah.
make. So even though you're neutral geared, even at best,
At best.
you could still be losing out because
I know.
you still got to make those principal repayments.
Exactly, at
and that's
best.
coming out of your pocket too, not
best,
not
right?
not the tenants.
That's right. Look, you don't mind. You're renting. Let's call it a 1-bedroom apartment for yourself.
Yep.
In the city because you want to live the dream. Now, obviously, that's not sustainable now because you've got all these investments loaded up, high rates, money out of your own pocket, blah 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 blah. Some of the tips you could go is, mate, well, obviously move back home. That's number one. That's $500-600 saved. Especially with the rental yields these days, especially with the rental market these days, very high competitive, right? So you're paying a lot.
So it's actually quite expensive
It's
to
actually
rent.
quite expensive, right?
Even if you're looking at the option to rent instead of owner
Exactly.
occupy. And investing is an expensive strategy also.
Right. And that's why, look, maybe go back home, live with your parents, right? Live with your brother, right? Or do you know what? Rent an apartment out with your mates. Because, you know, instead of paying $800 a week in rent, mate, let's divide that by 3, right? Or 2.
$300 sounds a lot more achievable, isn't it?
Come on, right? Do you know what I mean? And I think that's what people are doing now, shared houses.
Yes.
Right? A lot of people are doing that shared house stuff, right? With mates.
Correct.
Do you know what I mean?
Yeah.
So, yeah, look, that's probably the biggest tip is that can save a lot of money.
Good answer.
So what would you say some of the common misconceptions it is when it comes to lending and things like that and trends that you hear? Would you hear much about that?
Man, I can tell you, I think the biggest misconception is what a lot of consumers think about mortgage brokers. Okay? In the mortgage industry, we take up 70% of the business in Australia.
70%.
Up to 70. So just I think it's just below 70%. Wow. So mortgage brokers actually write 70% predominantly in Australia. Okay. Right, so the other 30% will be taken up by bankers essentially, right, or employees, right? So the other 30%, they still have this. All right, number one, they're old school. Number two, they've always dealt with the bank directly, and because of the relationship, whatever you want to call it. But still, there's still a big portion of it where they still think mortgage brokers actually charge a fee. So they actually think that, hey, we bake our fees into the mortgage repayments, right? Or we charge a fee at the end or upfront. Look, some mortgage brokers do charge an engagement fee, right? I'm not saying it's right or wrong, but some people do charge it, okay? Because I can understand why they charge it, right? I'm talking to Twan, right? I got to spend my first hour with him. I got to answer all his questions. I got to do my borrowing capacity with him. I got to give him the banking products. I got to do my research. So from end to end, your process could take anywhere between 2 to 3 hours. Let's call it 2. Right.
Especially I can be quite a difficult client.
Exactly, right? Especially a heavy hitter like you, right? And do you know what, Tony? You can just go, do you know what? I don't want to use Tony. I'm just going to go to the bank directly with what he told me. I'm going to list bank directly myself.
And I have the right to.
And you have the right to as well, right? So that actually burns some of us brokers, right? So yes, right?
Because you don't get paid for the work, do you?
Exactly. So that's 2 hours. Right? That's 2 hours of work I didn't get paid for.
Yeah.
Okay. So yes, a lot of people still think we charge a fee. That's the biggest thing. We still charge a fee. It's baked into the repayments, right? Or we charge a fee up front, right? Not like I said, so not all of us charge a fee. Some of us do charge a fee.
But the truth is, doesn't the fee come out of the commission that comes from the bank? So whatever the bank's commission is to you guys are going to get a small cut of that, isn't it?
What I say to you, correct. What I say to customers is, well, if you go to a bank directly, you engage in a lender, right?
One lender,
right? Let's call it one lender.
Let's
call it one lender, right? Well, that lender gets paid a salary. They don't work for free. They get paid a salary.
Yep.
Right? But you have to think of, we are pretty much the same, except we get paid a service fee. Right, because we're not employed by the bank, so they can't pay us a salary. So that's the only reason. So so I think the wording, right? Sometimes the wording actually really deters the client, right? It's he gets paid a salary, you get paid a commission, or what I like to call it is a service fee.
Yep.
Right.
Yep.
I think that wording,
the word commission alone has bad stigma tied to it.
It is, and I actually prefer to change the word as a service fee because essentially I am servicing you.
Yes, exactly right.
We're starting now Duotax Insurance as a brokerage firm, and what we've found is some of the challenges around the word commission.
Yes.
Talking to property investors who need landlord or building insurance, hearing us say, "Oh yeah, we do receive a commission out of this," or the person that referred you is getting commission out of this.
Yeah.
It has this really awkward stigma that really kind of grays the transaction.
Yeah. And I don't think anyone out there is actually working for free when they actually do that. Everyone knows that we're here to work. Everyone's here to make money.
Yeah.
So they need to understand that process. And
because in their mind, when they hear the word commission, it's like, well, okay, if it's commission, how much is it costing me? Right? Yeah. Really, if there's more educational content out there to say, hey, do you know, we actually don't charge anything. Right, it's actually my service to you.
Yes,
it's actually free.
Yes,
right. I'm actually connecting you to all these lenders I have out on the market to find you the best product for you
that suits us.
On that exact point, we have a lot of potential first-time people watching here. Give them some key differences between coming to a mortgage broker like yourself or, going to directly to a bank for argument's sake. Why, people may get a little confused as in why they would come to someone like yourself
why
or
the
go
former?
directly. Yeah,
cool. So look, Twan, you said it before, right? Hey, I'm going to go to a bank with CBA all my life, right? All my accounts with CBA. Do you know what? Because I'm a loyal customer, I'm going to go to the bank directly with CBA. Now, when you go to the bank directly, CBA, what brand products are they going to sell you?
One.
One, right? Exactly
CBA's
one,
brand,
right?
yes.
CBA, right? They're not going to see you it's Adelaide Bank, Westpac, St. George, ANZ, NAB, right? They're not, right? So my thing is, okay, well, how do you know CBA is going to give you the best product?
You don't.
You
'Cause
don't.
You've got nothing
Okay.
to compare to.
Exactly. You don't, right? So when you come to me as a mortgage broker, we have up to 40 lenders on the market that we can use under our panel. Look,
Okay.
we don't use all 40. I'm going to be very transparent, right? People that say, hey, we got 45, 60 lenders under our panel, it doesn't really mean much.
There's only a handful that you would trust.
Correct,
right?
correct. There's only a handful that you trust. Look, I'll say if I have 45 under my panel, I think the last financial year I used 12, right, for different purposes, right? It could be for valuation purposes, rates.
And sometimes
something,
people
matter.
have very difficult borrowing circumstances
Yeah.
where they can't go to the top, and so
Correct.
you have to then recommend other services. So
Yes.
it's always
Correct.
good to have those backup
Correct.
strategies in place with
Correct.
second tier lenders and things.
Yeah,
right?
correct. Right. And to answer your question there, right? Yes, we have to give choices.
Yes, that's
We have
right.
to give
It's not a
choices.
one
right?
size fits all. You
Exactly.
have to understand the client's unique needs
Yeah.
and then go out there and find the best product for the client.
Correct. And a lot of these, we still have consumers out there in the market that thinks that, hey, we have a preferred lender. We have a preferred lender that we want to take you to. Look, it's not the case. Look, okay, I'll take that back. Some do. Some do. Okay. But it's not the case because a couple of years ago, APRA brought out a rule where it's what you call best interest duties. It's you have to provide customers a product selection and advise them why do they think that product fits you. So for me, if Twine, you're a first-time buyer, you got 20% deposit, PAYG, bank, no problem, serviceability is not a problem. I have to present you up to about 3 or 4 products.
So that's
based on the market.
required now, is it?
Look, you should. For
Yeah.
best interest duties, you should, right?
Which should always be the case with the mortgage because that's why we're going to you. 'cause
Correct,
You've
exactly.
got options, you've got choices, you've
Exactly.
got an understanding of various products that will suit and tailor to my needs, right?
Exactly, right? It's what you call best interest duties, right? Mate, if you go to the
Makes
bank,
sense.
you have one product, there's no best interest duties there apart from, hey, I'm just going to sell you a product.
And on this point, just to cut you there, my sister, for example, she was banking with, I believe, ANZ at the time, and she was comfortable going direct to the ANZ bank. And I said to her, why don't you get a second option on, just a second opinion about what your rates are and whether it suits you? So I recommended her to a mortgage broker.
Obviously not me, but
that
yeah,
I-
anyways,
that I-
yeah.
that I trust.
Yeah, here we go.
That
Here we
I
go.
trust.
I think you left the voice message. You might have not received.
You should be answering your phone calls. And so she spoke to the mortgage broker and she said, I said to her, better have a chat.
Yeah.
The mortgage broker actually said to her, look, I'm happy to bank you and find the best products that suits you. She said, no, I want to stick to my bank. And so she went to get a rate and she said, give me your best rate possible. They said, this is the best rate possible. And then she gave it to the mortgage broker. The mortgage broker said, we can, without even calling anyone right now, I'm confident I can get you this rate from a different bank. And she said, that's unbelievable.
Yep.
So she went back to ANZ and said, look, I'm going to move because so-and-so. They actually beat that rate after she picked up the phone and spoke to ANZ Bank and said, I've got a mortgage broker that's offering this rate, not even in writing. This is all verbal. So for the fact that it wasn't even contract and they were willing to budge, just shows the kind of mindset when you go in a bank directly with one bank, that the control that they have over you, the leverage they've got in giving you a product that's not even the best product for you.
Well, it comes back to you don't know, right?
Exactly.
That's the thing. You come right.
So it's always worth even just having a second. And she essentially moved because just of that sheer benefit in even having a basic conversation with someone and someone saying to her, hey, you could there is better out there for you.
Yeah.
And just having that conversation changed her mindset about mortgage brokers.
100%, right? And to add more onto that then is look, as a mortgage broker, we can't run a successful business if it's going to be a once-off transaction. So I've got mates, I told you my 2 mates that worked in a bank before, that we started a mortgage broking business together when we first started out. So if a customer came up to him, so if an existing customer that they settled a deal for came up back to him, go, hey, I want my rate reviewed, they actually don't handle it. They go, no, you have to call up the retention team yourself. But you come to us, hey, Tony, if you're a good broker, you don't even have, this client shouldn't even have to come to you and go, hey, can you get me a better rate?
They should be on the proactive.
Correct. They should be on the proactive, right?
Exactly what we spoke about at the start of the episode, where we were saying that, once the loan's done, people think that a broker's job's done and dusted.
That's right.
It's not.
That's right.
Yeah.
Especially right now, I think it was like 10, 11 interest rate rises, right? What we've been doing for our clients is we've been hitting them up for the current rates because they've gone up so high. We've even lost track. We've even lost track, right? I even lost track of my own loans, right? So we've actually got their loans, got their rates, and we actually went back to the bank directly and repriced everything. right? And more than likely, they've actually have been given better rates.
That's great.
They actually have been better rates.
Yeah.
Right. So that's another.
And that's why the very essence of having a mortgage broker.
That's right.
Someone that's proactive looking
in
after
your
you.
corner.
That's right.
Yeah.
That's right. And I'll say it again, that we sort of deserve that service fee, that trail service fee at the back end, because that's the fee that my associates gets paid by.
By that one phone call, you could have saved the client X amount of dollars straight away.
Exactly.
But even going to a mortgage broker, it doesn't negate you from or lose you any service offering from the bank directly, right? Even if for example, if I engage a mortgage broker, not you at this stage.
Yeah, I know.
Tony,
Again. I mean, it's just rubbing wound. Rubbing on the wound.
You should respond to my message.
Right.
I'm going to send some inquiry.
Right.
But if we go into a mortgage broker and we bank with Commonwealth Bank,
Yep.
it still allows us every right to get the full suite of services from Commonwealth Bank, right? It doesn't.
Yeah.
We don't lose any service from them, even if we're going through an agent like yourself.
Correct, right? So you can still go to the branches, you can still call up the customer service team, right?
Yep.
But where we come in place is, you know what, we're going to give you the advice at the back end. We're going to give you the advice,
That
what you
they
want to
know.
do now, what you want to do tomorrow, what you want to do next year, right? And we'll also review your loans every 12, 18, 24 months, which we should be anyway, right? Because that's what we get paid for. That's what we get the service fees for. We have to look after you. And that's what a lot of brokers should be doing let's call it 6 months.
Right now, that's very important.
Exactly,
isn't it?
exactly.
Very-
That's-
but those
that's-
people who didn't go to the mortgage broker right now, I don't think the bank's calling them to ask them,
Yeah.
check on their loan. They're just probably passing it on.
I know. And sometimes, look, we do it as a goodwill. We do it as pro bono goodwill where, hey, do you know what, Tony? We're on a very high rate, but we know, look, it's very hard for them to refinance that because of the lending criteria that's changed a fair bit, right?
Yeah.
So we actually take 5 minutes, reprice the loan for our clients, and mate, they can, just like that, in 5 minutes, they got a way better loan,
Yeah.
way better rate, than what they were originally on, even though they weren't my clients. So, mate, just a quick 5 minute.
And it doesn't cost you anything.
It doesn't cost anyone anything.
So you touched there briefly on the lending criteria.
Yeah.
So what will be some of the key things that you've seen change over the past 12 to 18 months? Some of the key things that maybe, people may not realize that they could actually focus on something to help out.
I think the three biggest changes that has changed, let's call it the last 12 months, for first-time buyers is probably the stamp duty reforms, right?
Okay.
So
Which has changed again.
Which changed again, right? So that's annoying. That's very annoying, right? Because
Yeah.
that's sort of what's driving up the prices right now with low supply, right? And all these benefits going or abolishing. That's what's driving up the prices in a way, right? So let's say, for example, the Liberal government is it Dominic Perrottet,
Yep.
right? Dominic Perrottet, right? He put out this new stamp duty reform where, hey, do you know what? If you buy something up to 1.5 mil, you can pay the annual land tax. So I don't have to fork out
Instead of stamp duty.
Yeah. So I don't have to fork out the stamp duty up front, right? Because not everyone has 30, 40, 50 grand in the back pocket for stamp duty itself. So that was very good for people that wanted to buy up to the 1.5 mark. And what that would last for 6 months by when July hits, when the Labor government introduces their reform, right? Where
Effective this July.
Yeah, correct, right? No stamp duty for up to 800, but a concession between 800 and a mil.
Yeah.
So that's going to drive prices again.
And we were
Right?
just talking about this to the
Right.
previous guests, and they were accountants, and they said, every time they come up with legislative changes that give credits, or what was it? What was the right term?
Deductions,
No, they're giving.
the benefits.
Yeah, what do you call
Schemes.
it? Schemes, yeah.
Schemes.
So every time they come up with a new scheme that gives money away to people to help them
Yeah.
put into their stamp duty, put into the first home buyers grant, things like that. If they jack it by 25 grand, all the suppliers load their prices up
Exactly.
by 25 grand.
Exactly.
That's right.
And
Exactly.
funnily enough, all house prices then
Go up.
Exactly.
go up.
So now it's got to a stage where, do you know what? Which party is it to blame for driving up all these prices with high interest rates? Which party is it? Well, it looks like it's both,
Yeah.
right? It looks like it's
And
both.
not to mention all the government handouts throughout
Yeah.
COVID.
Yeah.
That probably didn't help
Correct.
things either.
Yeah, right. And another big change, right, is bond capacity, right? That's probably one of the biggest changes in the last 12 months. So since April, we've probably had 3.75% rate rise. Okay, so organically, that pushed people's buying power backwards by about 30%, 35%.
Exactly right, yep.
So for example, right, if I had a buying capacity of $1 million, yeah, $1 million, right, back in April 2022, but because
The good days.
right, the good days, right? And hey, I see the rates going up. You know what? I'm going to hold off on buying a property because I'm waiting for the prices to go down. But at the same time, these customers don't know the buying capacity also goes down as well.
It's dropping as well.
Yeah.
Right? So we got to a stage where, you know what? Your bond capacity actually reduced by 30 to 35%, but the house prices hasn't reduced by 30, 35%. So
That $1 million now is only 700,
Exactly, right.
750, 650.
So now
It's a
you
big
got
difference.
so you now got that gap of, let's call it 10% from what you can borrow and what the prices are now. So I can't even buy what I want 12 months ago. I got to settle for something a bit out west, for example, something that I'm maybe half interested
Compromise.
in. Exactly, I have to compromise, right?
And
that's killing it.
Is it true that at the the lending from 12 months ago, the buffer that they had in place to sensitize interest rates to make sure that people can afford it in case of rate rises that are happening like now, the buffer was not enough for what the type of rate rises we've had now? Like, for example, if you sign up to a 2% deal 12 months ago or even 24 months ago, they would have only buffered what? 4%?
Yeah.
And now we're a little bit more than that. So
well, see, that's the problem, right? Who knew they were going to jack up the rates so high, right? APRA probably think, hey, they were doing the right thing by putting a stress test assessment rate of 3% buffer. Now, that buffer rate was actually introduced by APRA, so it wasn't introduced by the banks.
Right.
Okay, the banks actually had to listen to APRA, so don't always blame the bank.
Okay.
All right. No, so like consumers shouldn't be blaming the bank, right?
So we're getting credits to all the people out there with the big four.
Yeah, I know,
Yeah,
right?
not
I know,
all
right?
to blame there.
I'm going to hit comms, man. I'm going to hit comms this month, right? I'm going to pay my comms in my service fee.
Service fee. Yeah.
But yeah, right? No one knew that, hey, the RBA was going to jack up the rate so high, right? So, maybe they thought they were doing the right thing. But essentially, they weren't. Well, I wouldn't say they weren't, but
it wasn't adequate.
It wasn't adequate. Or, what? It might come down to a situation where the RBA and APRA didn't talk enough. But what? Talk about buffer rates, right? That's another thing. Because right now, because the rates gone up so high. So let's say, for example, you bought a property in May. In April last year.
Yep.
Okay, but the rate's gone up so high now. Your rates are so high now. So the rate's gone up so high, and your actual interest rate's gone up so high, where, hey, I want to shop around for a better rate. But because you already capped yourself at borrowing back in April, you can't borrow that. Let's say you borrowed $1 million.
You're technically not able to even buy the same property.
Correct. So I can't even service that loan. That is the problem. So this is what we call mortgage trapped, right? I'm trapped at that bank. Hey, do you know what? I might have to keep paying that high rate, and I can't shop around. Now, APRA actually introduced a new buffer rate, okay? Because they see this happening with consumers, right? That had their mortgage trapped. So there was talks a long time ago where they were going to change the buffer rates because the rates have gone up so high now. So instead of the 3% buffer rate, they actually introduced a 1% buffer rate. And that's only announced by the Westpac Group on Monday.
So Westpac now will have a bigger appetite for lending again.
But that's only for refinances.
Refinance
Only. But see, that actually... So
to bring business across.
Yeah, well, number one, bring business across. Number two is giving consumers the more opportunity to get a better rate. Right, because that decrease in 2% buffer rate actually increases your borrowing capacity by 15-20%. So now, hey, do you know what? I'm not mortgage trapped anymore. I can go to another bank
For another option
where they will treat me as a new look, I hate to say it, right? But most banks these days want new business. So to get your new business, they're going to give you the better rate in comparison to an existing customer, unless you say, hey, I'm going to leave. So yes, I think that's the biggest change as well.
Cool.
It's a buffer rate.
Will the other banks, you think, follow this type
100%,
of trend?
They will, 100%. Yeah. So I think it's just a matter of time.
Yeah.
All right. Because if the Westpac Group had to introduce it, the other banks have to. But like I said, you have to make certain parameters to use criteria to use that 1% buffer rate.
Okay.
Yeah. So
well, it's good for listeners out there and viewers out there to know that there are options if we felt like we're being mortgage trapped, which is a new term.
That's a great tip, right? Because people can probably get so caught in their own problems, their own issues, they may not be able to understand, or they may not even have anyone to talk to. And just hearing those little things like that can may spark something in their mind to go and have a chat to a broker or have a chat to somebody.
I'm going to give an example this week. So we heard news on the back end last week, right, that they were going to introduce a new buffer rate. So I started planning with a lot of my customers the new customers that we had a chat to that I couldn't refinance. Okay. So this one particular client, I couldn't refinance because the buffer rate was just too high, right? And he didn't make servicing. But I knew if the buffer rate was reduced a little bit, he would have serviced. So I've done some calculations with it's just a 1% buffer rate based on current rates. He was able to service the loan. So he was stuck at one of the big four banks. I don't want to say which bank. One of the big four banks. I think he was stuck at 5.81%. All right, and we were able to refinance him. I think it was 5.41%. With the Westpac Group, because of the new buffer rate. Right. Okay. And that was a $700,000 loan, by the way. Right. So you work out the maths, right? He saved himself 0.3%.
0.3, yeah. It's a decent chunk.
Man, come on. Yeah. Right. So this new policy, new buffer is actually helping the customers a fair bit. Yeah. Right, for the good.
Tony, out there in the market, there are people that are now today outlaying a lot more cash out of their pocket. with big property portfolios, sometimes even one or two properties,
Yep.
you could be in a position of negative cash flow.
Yeah, 100%.
Right? So are there some of the strategies or some of the advice that you got, maybe not advice, but maybe a tip as an investor yourself that you might have for people out there that in this circumstance of being cash flow negative?
Yeah, sure. Look, I'm going to give myself as an example. Yeah. So I have an investment property around the Wollongong area. I was one of those guys where I fixed it at a very low rate. I think I fixed it at interest only at 2.49%. Interest only.
Good old days, as we call
Good
it.
old days, right? I was actually positive cash flow by about $1,000 a month on that property. Right, but now obviously, the good times are gone, right? It's actually jacked up to about close to 6% now, interest only variable. Now, I normally don't like to add this into my calculations to soften the cash outlay, right? So obviously now it's 6%, there's a lot more money out of my own pocket to service that loan because the rent will not cover the interest repayments.
Yeah.
So look, to soften it, and I never used to do the calculations like that, but to soften it, you can talk to your accountant for the negative gearing benefits, right? Where I can claim back the extra interest that I'm paying now. That will soften
Which is a significant amount, right? You more than double the interest rate on some people, especially going from interest only to interest and principal on a 6% loan. That's a huge amount versus 2.49 interest only.
Right. So obviously 100% is going to be negative geared. So number one is you can talk to your accountant and say, hey man, what sort of tax benefits I can get back from the interest charge for negative gearing. Right. But I think a lot of people not a lot of people, but first time investors is, hey man, there's something called a depreciation schedule, which is what you guys do, right?
Yep.
I don't know the whole logistics of how it works and all that, right? But if you buy a property tomorrow, which is let's call it existing house, I think you can claim back the structural depreciation. Is that correct?
That's right.
Right?
You got it.
I got it. Right, I got it.
That's why you're in the top 10. That's why you're in the top 10.
All right. So you can claim back the structural depreciation. Let's call it $5,000. Let's call it, hey, negative gearing. I had to pull out $7,000 out of my own pocket, right? Cash outlay for that particular. Let's make even number $5,000. Cash outlay from that investment property. Yeah, so I can claim back that $5,000.
Yep.
But also, let's say, hey, on the first year of that depreciation report, I can claim back another $5,000. So really, I can claim back $10,000 now.
So you've doubled your tax deduction,
correct,
just by having a depreciation schedule because you've also got the interest.
Yeah.
So it's a $10,000 tax deduction.
Correct.
On the first year.
So really, if I'm on $80,000 minus, look, I'm on $80,000, I'll claim back $10,000. I'm going to get the $10,000 in tax back.
Correct.
Yep. Right, so which is yes, look,
you're not going to get tax at that rate. You might be $3,000 or $4,000.
Yeah,
up.
correct.
Yeah,
correct. Right, yes, it's not everything. It's not everything,
but
right?
It's cash flow.
But it's cash flow. It sort of softens the blow a little bit.
I think every little bit helps.
Yeah, 100%.
Every little bit helps when things have gone as crazy as what they've gone so far.
100%.
Every little bit can help.
Yeah, and man, do you know what? The amount of first-time investors that don't understand you can claim there's something called depreciation.
I was one of them.
You'll be surprised.
You'd be surprised. Yeah, I am surprised at how many people don't know about it. And unfortunately, some people, they take to the internet or they don't have an accountant and they don't get this advice.
Yep.
So it's always recommended, hey, if you get into property, you've got to get the right people on your team, right?
Yes.
Mortgage broker, right? Accountant.
Yep.
And I think these people are very critical to the success of your investment.
Yeah, 100%. Right? Because you need the accountant to work a proper cash flow at the end of the financial year for all your tax deductions.
To make sure you're in the green.
Yeah.
Right? And if you're not, maybe you should be revisiting what you're buying or revisiting who you're talking to and what type of properties you're investing in.
That's why you use a mortgage broker, mate.
Yeah. Hey, without a doubt. Not just any.
Yeah, not just any. That's right. That's right.
No, thank you so much, Tony. It's been really insightful, and I think the audience is going to get a lot of value from this. And of course, I'm a big believer in when it comes to property, you need to have the right team with you, and finding the right product to suit your needs, especially when it comes to finances, is critical because it can make or break you if you don't get the strategy right from a finance perspective. We've talked about tax and how critical that is and setting up the right structures. But with finance is equally as important, and having that reviewed, not just on the outset of purchasing, but also, as you go on with the journey, 6, 12 months, 24 months down the track, you want to be staying on top of these interest rates, making sure that you're getting the best product and making sure that you're maximizing your borrowing capacity to buy more.
Yeah.
And that's where a mortgage broker can really add value.
Look, you can buy more as long as you can sustain it.
That's it.
That's true.
Right?
We can't do rice and soy sauce. If you can't do it, don't borrow too much money.
And just last words for me is investing is one thing, growing wealth is one thing, but you also have to have that perfect balance of debt and lifestyle. right? Like I truly believe in that. There's no point of loading yourself up in debt, more debt, when you can't have a life. You got to enjoy life a little bit. So there, we'll always find that balance. Hey, what's sustainable? And I can still go on my first class tickets to overseas like you, Twine. Right?
I'm still dreaming. I'm still working on that. Awesome. A few more greys like you, I'll be there, I reckon.
Yeah.
Beautiful.
No, thank you.
Thanks, Tony.
Thanks,
Appreciate
guys.
it.
Appreciate
and guys,
it.
thanks for watching. And if you found some value from today's episode, please hit that subscribe button or share it with a friend. Thank you.